Welcome to the Deep Dive. Today we're looking at something, well, it's not another flashy token launch or a big price swing. We're actually digging into a really significant move by BlackRock. It's subtle, but potentially massive. It seems like it could really reshape the digital economy. We're talking about them cementing their role, not just as a crypto buyer, but maybe as the owner of the core financial plumbing, the rails that stablecoins run on. It's a really critical story, I think, about how traditional finance TradFi is kind of locking arms with the stablecoin world.
That's a great way to put it. And yeah, if you really want to grasp how serious this is, you have to look at what sounds like a pretty dry product. The BlackRock Select Treasury-Based Liquidity Fund, BSTBL. This fund, it's getting a major strategic overhaul, and this isn't just a minor tweak. BlackRock is specifically retooling this liquidity vehicle to be the go-to reserve manager for stablecoin issuers. Institutional grade. They're effectively building a gateway, positioning themselves as potentially the essential gatekeeper for digital payments down the road.
Okay, right. Let's unpack that, because a liquidity fund, it sounds incredibly dry. How is that the secret weapon here? What exactly are they changing inside BSTBL that suddenly makes it so important for, like, Web3 and digital payments?
Well, the changes are very deliberate, and they're clearly looking at the regulatory side of things. There are two key operational shifts happening. First, they're putting in a really strict 5 p.m. Eastern Time trading deadline, super tight. That's all about ensuring ultra-fast settlement, liquidity certainty, no ambiguity. Second, and this is maybe the main point, the fund's getting a much heavier mandate towards U.S. Treasuries and only the absolute highest quality liquid assets. They're making this fund incredibly clean, mathematically speaking, hyper-liquid.
I get the liquidity part. That makes sense. But why the big push for this, ironclad structure right now? What's the rush?
Because it lines up almost perfectly with the stablecoin regulation everyone expects is coming down the pike in the U.S. They're definitely reading the regulatory tea leaves here. Think about proposals like the Genius Act. That kind of regulation, it's designed to force stablecoin reserves into really strict boxes, usually demanding one-to-one backing. And backing with what? High-quality liquid assets. Think cash, short-term treasuries, things that make the tokens easily redeemable. So BlackRock is basically building the exact vehicle that meets those requirements, those qualified assets, perfectly.
So they're not just reacting, they're anticipating.
Yeah.
Preempting the regulation almost. But isn't there a risk? I mean, what if they build it to the wrong spec? Why move so fast before the legislation is actually, signed into law?
Well, that's kind of the genius of the move, as some of our sources put it. By getting this solution out there before the rules are totally locked in, BlackRock basically sets the gold standard immediately, a compliant one. Think about it. No smaller issuer, no decentralized protocol can really match the credibility, the operational history that BlackRock brings to cash management. They instantly become the obvious choice, the de facto reserve asset manager of choice. It's that speed combined with their compliance know-how that creates this huge moat. It's almost impossible for others to cross quickly.
Oh, right. That makes sense. And that leads us straight into the strategy, the why. This infrastructure grab. It's not just about selling another financial product, is it? It feels more like controlling the actual foundation.
Absolutely. This isn't like them buying Bitcoin directly. It's about plugging into the critical infrastructure, the stablecoin issuance plumbing itself. Think of a stablecoin like a house. BlackRock wants to manage the foundations, the utilities, the water, the power. By managing the reserve backing side, which becomes totally non-negotiable under strict regulation, they're essentially controlling the stability of these huge multi-billion-dollar tokens.
And their sheer size, their existing scale, that's the ultimate weapon here, isn't it? We're talking numbers that just dwarf most crypto companies put together.
Exactly. Scale is. You just can't ignore it. BlackRock's cash management division just blew past $1 trillion, $1 trillion in assets under management. So when they offer a liquidity solution, they're offering this unmatched level of, everything. Auditing, regulatory scrutiny, and crucially, the ability to manage reserves at a scale that ensures stability, even for the biggest stablecoins out there. They're basically saying to issuers, look, we give you the compliance shield and the liquidity efficiency you absolutely need to operate safely and grow.
And we know this BSTBL thing isn't happening in isolation. It fits into their bigger picture, right? Their push into digital assets like the ETP's tokenization.
Spot on. It's all connected. Every move they make, you mentioned the Bitcoin and Ethereum ETPs, their big push into tokenizing assets. It all points towards dominating this emerging on-chain finance world. And they already have credibility here in this specific niche. We know, for instance, they've managed reserves for Circle before, the USDC issuer. So yeah, they're not just dipping their toes in, they're methodically institutionalizing the rails, leveraging relationships and expertise they already have.
Okay, this is where it gets really interesting for me. The implications. If BlackRock provides this trusted, massive infrastructure, what does that actually mean for all the other stablecoin issuers, especially the newer ones, the more decentralized projects, maybe smaller teams, trying to build a truly open financial system?
Yeah, it creates this huge trade-off, doesn't it? On one side, a big issuer can basically tick the regulatory compliance box and gain instant operational trust just by using BSTBL. It's like the easy path to legitimacy. But, and this is a big but, that convenience comes at a cost. It potentially sacrifices decentralization.
I mean, I get the efficiency point, but doesn't it feel a bit hypocritical?
Yeah.
You have this giant firm, one that was pretty skeptical of crypto not that long ago, and now they're rushing in to build the centralized plumbing to support it. It kind of makes the whole ecosystem dependent on these TradFi players again, doesn't it?
It definitely raises that tension, yes. This move significantly lifts the bar for smaller players. They now have to compete against the sheer transparency and the institutional grade liquidity of something like BlackRock's product. This push for professionalism, it effectively squeezes out those less efficient, maybe murkier reserve strategies, the ones that relied on, say, complex collateral baskets or less liquid stuff. If you can't prove your compliance and liquidity instantly, how do you compete with the BlackRock standard? It's tough.
Okay, but beyond squeezing out smaller players, what about the systemic risks?
Right, that's the other big question, concentration risks.
That has to be the main worry, yeah. If a huge chunk of the stablecoin market ends up backing its reserves through just one or maybe two giant financial firms, what happens if that institution hits a crisis or, faces political pressure?
Precisely. If BlackRock becomes, let's say, a too big to fail reserve manager within the crypto space, well, we've just swapped one kind of centralization risk, maybe a centralized issuer, for potentially an even bigger one, centralized reserve management. So issuers face this really critical choice, you see. Do they go for the efficiency, the regulatory safety net offered by one huge asset manager? Or do they deliberately choose independent trusts, maybe spread their custody around just to maintain some redundancy in the system? It's a fundamental decision.
And BlackRock isn't the only player eyeing this space, I assume. Are other big TradFi names making similar moves?
Oh, absolutely. The competition is definitely heating up because I think the market now recognizes that managing the reserves, that's the real long-term prize, maybe more so than just facilitating trading. We're seeing reports, for example, that institutions like Citigroup are also exploring custody and reserve management services specifically for stablecoin assets. So yeah, it shows this broader institutional realization that the plumbing, the foundational layer of stablecoins, that's where the steady utility-driven revenue is going to be.
So connecting all these dots, looking at the bigger picture, this BlackRock move isn't just about crypto. It feels like it reinforces this idea of a hybrid future for finance.
That really seems to be the overarching thesis, doesn't it? We're literally watching TradFi build bridges directly into crypto infrastructure. You've got on-chain systems and off-chain systems interlocking. And guess who's stepping in to manage the critical back end? The regulatory compliance shield. It's the established financial giants.
And I think a key observation here is how this shifts focus, capital, attention. Maybe away from just purely speculative tokens, more towards this foundational stuff.
Correct. This move, it subtly steers the conversation, and maybe investment too, towards stablecoins and payments infrastructure, positioning them as the potential backbone for Web3, moving beyond just asset speculation. BlackRock's approach here, providing utility, providing compliance, building core infrastructure, it's described in some of the material we looked at as the winning type of behavior in this long-term convergence or maybe battle between old and new financial systems. They're not trying to fight the digital asset trend anymore, it seems. They're building the parts of it they know how to control, how to monetize.
Okay, that brings us nicely to the key takeaways for you, the listener. First off, definitely keep an eye on funds like BlackRock's BSTBL and similar ones that pop up from competitors like potentially Citigroup. These aren't just boring investment funds. They're shaping up to be potential gatekeepers for the whole stablecoin infrastructure.
Yeah, and critically, watch the adoption. Which big stablecoin issuers actually decide to plug into BSTBL or these other institutional products? That decision, that's probably the clearest signal you'll get about where the industry is heading. Is it towards more centralization, towards professional regulatory compliance? If you're building something in this space, you really have to factor in this immense advantage incumbents now have, combining that institutional scale with perceived regulatory trust.
Right. And as always, we'd like to leave you with a final thought, something to chew on.
I think the big question here is this. Does chasing that regulatory trust, which is essentially the product BlackRock is selling, does that inherently mean giving up the very decentralization that digital assets were kind of designed to offer in the first place? That feels like the core tension. And it's probably going to define a lot about finance over the next, say, decade.
Absolutely. A lot to think about there. And hey, if you found this breakdown useful, if you enjoyed this deep dive, please do consider sharing it. Maybe subscribe if you haven't already. Leave a comment. Honestly, engaging with the video really does help us out. It supports the channel, boosts visibility in the algorithm, and lets us keep making this kind of deep dive content for you each week. Thanks for tuning in, and we'll catch you on the next one.